in Baddock, Nova Scotia. Good evening. Your question.
Good evening, Anita. Jaime, in your opening statement, you made the drastic comparison of the current situation to the 30s. That's a bit scary. And since October, you have been suggesting that people reduce their equity holdings and increase the cash position. Which sectors would you suggest that the average retail investor, which sectors should we vacate first, and are there any that we could hang into for a little while longer? And how high would you build your cash position to?
Okay.
Thank you.
That's a great question, Earl. Now, the answer to that question lies in what I did in the summer and how I position clients. The first thing I did was analyze the cash flow that the dividend income portfolio, which is somebody like Earl would need, was delivering. Then we reorganized in a way that we raised cash, so we went up to 30%. We're sitting in about 25% cash right now. Some of that is sitting in convertible bonds, so that gathered yield. So it's companies that I think are going to do well, and eventually they'll start trading like the stock. That's why I like the conversion. Then we reorganized the yield companies in a way we actually ended up getting almost the same yield that we had before the correction. Within the sectors there, what I want for somebody older is the cash flow. So I'm looking at pipelines, utilities, REITs, but I've just reduced the content because it's all companies I like that I want to be buying. I don't know which one comes back first. My concern is they're going to go down if the pension funds start selling. So that's why I want to have the cash and wait. Once the yields get good enough that I can build cash flow, then I will add, like AltaGas, even though they did cut the dividend. But long term, I think the company is going to deliver good capital growth as well. And it's still paying a cash flow. So that's how I would organize it. And I would definitely recommend the hedge of the precious metals because that's, and there as well, you can get dividend with if choosing the right companies. Within that area, Agnico, Kirkland, Franco, they're all paying dividend. And actually, they increased their dividend last year.
Okay, let's squeeze in one more call very quickly if you can. Mike in Annisville, Ontario, I know you're standing by. Good evening.
Yes, good evening. Jaime, just a question regarding Enbridge. I've held Enbridge, ENB, for a number of years. They seem to be a really solid company in dividends, and I just wondered maybe what the consensus is and what your thoughts are on that company going forward as far as their forecast, maybe a dollar value, the target that you're looking at on that.
Innisfil. I'll be driving by later on my way to Collingwood. Enbridge is one of the companies that I'm holding within the portfolio. I'm very comfortable with the cash flow, even though it's pulled back in price. But again, it's one that I am expecting to buy more later. Enbridge is a really good example of 2008 because in 2008 I did the same thing. I raised cash early in the year. By the end of the year, Enbridge was, I believe, if I recall correctly, had an 8.5%, 9% dividend. When everybody was selling in December, it was trading at about about a 9% dividend in 2008, and it had started the year at about 4%, so almost the same environment. At that point, I was quite happy to be buying when everybody was selling. So Enbridge is one that I'm very comfortable with. We have it as a buy with a $52 target, but having said that, targets will go out the door if we have a liquidity crisis and pension funds start selling because they become scared. Pension funds, mutual funds, all of this money that's sitting invested right now that hasn't even moved out, I'd rather be moving out now and get in when they're coming out, right? In 2008, the bulk of the selling was that in December, not in January. So again, I think it's, people are predictable. Okay. And by the time the fear kicks in, it's too late. I'd rather be early. Okay.
It's time for us to take another break here on Market Call tonight. Our number, Nick in St. John, New Brunswick. Good evening.
Hello. Good evening. Great show.
Thank you, sir. Thank you, Jaime.
Can I get your opinion on Crescent Point? I own a higher price. I wonder if he ever recover. And can I get the street consent too, please? And hang up and listen to you.
All right, thank you, Nick.
Crescent Point is a company that I've owned in the past for the dividend yield. It's one that I've been quite happy with, but I don't own it anymore. I don't have it. We have it as a speculative buy currently with a $7 target. My concern with the Canadian oil sector is more the fact that there's too many too many issues that have to be resolved in terms of getting our oil to market. We haven't done anything in terms of building pipelines to get to Asia, and the only buyer for our oil is the U.S. because all the pipelines go north-south. I like the pipelines because they're monopolies. We're not building any. That's where the energy, clean energy people, the lobbying has been great in that we're not building any, but now we have the pipelines or monopolies. But there's nothing going east-west. That's a concern. And because of that, Canadian oil right now, and I think it's going to continue to trade at a discount to WTI, West Texas oil, and global oil, right? The only area where we have North American oil being sold paying Brent is the Newfoundland oil that's being shipped to Europe. But otherwise, I'm very concerned for the energy. And
even moving through 2019.
Even moving through 2019, because we need some political leadership in terms of getting these pipelines built, right? I personally think that we need something similar to the Trans-Canadian Railway. It should be the Trans-Canadian Pipeline to be built today in the name of the Federation. Because why is Ontario buying American oil that's being refined that they bought from Canada at a much lower price, and then we're buying it back at a premium? That's silly when we have the resource. So to me, I think it's a political issue, and because of that, I'm shying away from the Canadian oil. I like international oil. I think oil as a component is a small percentage of the portfolio. But again, it's the politics and everything that's involved.
All right. And Nick, consensus-wise, we have 10 buys, 9 holds, 1 sell, and a 12-month price target of $7.97. More Ontario, good evening. Your question for Jaime.
Well, I don't know. He was just talking about gold. I had a question for him. I just topped up my TSFA, and then I was wondering about Algonquin Power or Northland Power, or maybe splitting it and do both. What do you guys think about that? And if you want some Yamana shares, I got some you can have.
John, thank you.
Well, if you need to take some tax losses, I'll take those Yamana off of you.
We have great viewers here on Market tonight.
Northland Power and Algonquin Power, I own them both within the equity income portfolio. I like them. They're steady cash flow. Keep in mind, though, that within the portfolio, I have taken a more conservative stand, and I am high in cash. I'm about 30% cash. And 20% in precious metals within that. So I would not really necessarily be selling my Yamana if that's the only gold stock you have. If you have less than 1% in gold, I would highly suggest adding to hedge. However, within this one, within the pipelines, within the utilities, I like both of these because of the dividends. The dividends are there. What I like about them is that they should continue to pay dividend for quite a while, and they're also inflation hedge. One of the nice things is that within companies like utilities, they always end up passing the cost to the end user, so they're very well hedged. The downside to them, though, is that pension funds own them. So if we do get a market pullback, I expect these to come off in price because it's the type of companies that the pension funds are going to be selling first. They're liquid, they're easy to raise money with. And because of that, I have cash because I want to add more later, expecting better buying times down the ways, because I do think that the market, again, there's a lot of system risk out there. So
a lot of opportunities to buy a lot more dips in our future for 2019.
Exactly, and I don't think it's time to be buying the dip just yet. I think I would take a look at the political problems and then assess. Like, we were talking about Brexit. You have the yellow vest in France. You have the issues in the strikes that are starting to happen in Asia. Those are very populous countries. You
Getting
have
word
Huawei.
that there's going to be a federal case started against Huawei from the US.
That's right. Then you have Syria. You have the Middle East. And then the U.S., which is getting worse and worse. We have a complete shutdown of government now for more, it's going to be 30 days in 5 days, which is a long time. Well, I don't see that getting any better. The Democrats don't want to give him the wall. He wants the wall. It's all about a wall. Well, that's going to affect earnings, right? The global earnings are slowing down. It's going to affect everything. One of the warnings I would be looking at is look at the banking index, how much it's come off since October. It's not signaling a pretty picture going forward.
We'll go to a tweet now. Mitesh, he wants to know about Canadian Apartment Properties REIT, or CAP. He wants to know about this one, and also housing affordability effects on occupancy rates moving forward. How are you on the real estate side?
That is a key concern, actually. There is a lack of rentals. They did a money raise just December, November, and I participated in it because it is one REIT that I like rentals. I've mentioned that on the show a couple of times. I allocated a little bit of cash into that because I do think that we have a problem on the rental side. You know, I have an apartment here downtown. The chap that's renting it can't afford it, right? But it's not big, right? So I'm wondering, how are young people going to be able to afford anything? They need to be able to rent.
Forget about buying. They can't even rent, you're saying?
Well, they can't get the down payment because
so
everything's
they are
going up so
renting.
much. So they
Got
need
it.
to rent,
Yeah.
but there's no rental units.
Right.
Right. And because of that, I think rental need has to be satisfied. And so the rental market is one area that I think it's quite well supported no matter what happens throughout the economy. And that's why I allocated a little bit. And Cap REIT was the one that I bought.
Is that a Toronto-specific story, or are you seeing a bullish situation across Canada?
On the rental side, the lack of affordability, it's a North America-wide thing.
Okay.
People don't have the money, and we've just had a massive rise in prices, right, because of cheap interest rates.